Hey traders, this is Blake Morrow with Trader Summit, and I'm really excited because it's been so terribly long since I've had him here. I'm happy to have Mr. Dave Keller, Chief Strategist over at stockcharts.com. Dave, good to see you. Always good to see you, actually.
No, good to see you again, Blake. It's been a while, and yeah, good to chat with you again.
Yeah, a while. I had to go back and look at the notes because I knew it'd been some time, and it was
Yeah.
actually near the end. I think it was October of 2022. You're a little nervous about the market. You're like, seasonality may play in to the market a little bit as we go into year end. And looking back in 2002, it was choppy to down, and so you were really right there. And then obviously at the end of 2022 and 2023, the market ramped up. And I don't know if we've actually even looked backwards since then, but since it's been so long. I'm really interested to hear what your take is on the market where we're at right now. I mean, obviously we're at all-time highs, and I want to, just take a step back and say, it seems like right now there's not much that can stop the market. We have, we have the Fed. We just got past the Fed meeting. Looks like we have cuts coming, at least three going into the end of this year. You have the Swiss National Bank just cut today. You had the Bank of England. Looks like they're not too far behind. I mean, basically, most central banks look like they're going to pivot towards an easing cycle, which is
Yeah.
obviously going to be just a tailwind to equities. So let me just stop there and ask, do you think we're going higher? And are there any cracks that you see below the surface? And if there are, what are they?
No, it's a really, really good question, Blake. And I would say, in this kind of environment when it's just a clear bull phase, and you can see that in a lot of different ways. I mean, to start off, just the benchmarks are going up, right? And as a technical analyst, you can define that by just saying, are we making higher highs and higher lows? Yes or no? And if so, the market's in an uptrend. I always say my 8-year-old son Henry, if I showed him a chart, would he say this is going up? And I've tested it recently. Henry says market's going up, and he's right. I mean, and that's just a basic subjective assessment, and really it's more objective than anything. I mean, is the trend going up? And it is. So I think the reality is that's sort of your backdrop, right? That's the framework with which you make sense of things. So the question then leads to, what would you need to see to tell you that we're at a top or near a top or after a top, right? And so you start to look for those leading indicators that things are starting to change, and what I'd call a change of character. I would say we're seeing one thing right now that tells me we might be nearing a top. I would say the second thing that tells me there will still be plenty of opportunities out there. So the first one is, what are the things that would tell you we're kind of near a topping point? It would be bearish divergences, right? So when a market is in a position of strength, stocks go higher on stronger momentum, right? Commodities go higher on stronger momentum because there's more and more of a buying power, for lack of a better description, kind of propelling things upwards. But at the end of a phase, sort of in the eighth or ninth inning, you start to see new highs, but on weaker momentum, right? So the price is going up, the RSI starts to slope downwards. And you've seen that recently with the S&P 500, with the NASDAQ 100, with leading growth names like IBM, which had nice breakouts, but they're breaking out on weaker momentum. Now, that can right itself if you start to see momentum improve, and we see new highs. And that's this week after the Fed. Looks like what we're starting to see is just renewed buying interest pushing us higher. But that would be like the one thing that I would be looking for would be growth names that have been so successful start to show weaker momentum. I think you're starting to see signs of that. That would be the warning sign that I would be waiting for. The other part would be what tells you that there's still hope, which I think there is. It's all the other stuff that's breaking out. I'm not excited because growth stocks are still working. I'm excited that home builders are breaking out, and gold stocks are not as good, but gold itself is breaking out. Bitcoin is rotating back higher. Steel companies, copper companies, heavy machinery names, kind of like the economy is going well kind of stuff is working as well. And I think that's, probably the more bullish thing I would say is not that Microsoft keeps going higher. It's the other things that you really want to improve if the economy is stabilizing and in good shape. Those are the signs that I'm starting to see now, which is encouraging.
That is encouraging. There's one index that's been like the Achilles heel of this market. It seems like, well, it hasn't really stopped it, but it's definitely, kind of thorn in the side, and that's the Russell 2000. And you've got the
Yeah.
Russell. I know it's up today as the day that we're speaking. Of course, stocks are at all-time highs, so the Russell's trying to play a little catch up. But why is the Russell just not participating, as so many analysts thought that the Russell was just going to play just 100% catch up with and maybe
Yeah.
even surpass some other indices. It just hasn't.
Yeah.
So what's your take there on the Russell 2000?
Yeah, I mean, I think it's a market structure question more than anything, to be honest with you. I mean, I was taught, a couple years ago, as you were, as we're learning this whole thing, I was taught in a bull phase, go with small caps, right? Because those are the higher beta, riskier bets. That's where they're less proven, arguably more upside types of names. That if the market's going to work, small cap is the juice, right? That's what's really going to give you elevated returns. And it's not been the case. And I would say 2024 is looking a lot like 2021 in that case, where you had a sort of slow and steady grind higher. Volatility remained low, so the VIX was pretty low that entire year. You didn't have that many drawdowns. We had drawdowns of like 3 to 5% on the S&P, but nothing more dramatic than that. It was just sort of this grind higher, and that was also dominated by sort of the mega cap trade. That's when like the FAANG stocks are a thing we start talking about because it's sort of those mega cap growth names that are dominating, and we've seen that once again here in January and February. If you look at the sectors that have been dominating off of the October low from last year, it's technology, communication services, those types of growth sectors. If you look at the sectors that are the heaviest weight in the Nasdaq and the S&P, it's those sectors. If you look at the sectors that are not a very big weight in the Russell 2000, it's those, right? The Russell 2000 is more about financials and basic materials and regional banks and healthcare names and other things that are just not the juice, right? So the stuff that's been working are not very well represented in the Russell 2000. I think that catch-up trade that you're implying, which I think is going to start happening a little bit more, it's because those other sectors start to improve. And when you see things like regional banks, like the KRE is a good ETF to track there. Those sorts of things start to pop. That's when you'll see the Russell 2000 close its performance gap because the growthy stuff that's been dominating, might not necessarily go down a ton, but it's just going to pull back like an Apple or like an Alphabet has done recently. More of that happens. More of the other stuff starts to improve. More of those value sectors. Russell 2000 starts to improve, and arguably, I think that's the environment we're going to be looking at here in the coming months.
So Dave, thing I love about you most is like, when I talk about technicals, it's kind of like if you're playing blackjack, and I hate using that analogy, but I'm really a by the book blackjack player. Like, if I've got a 16, I'm gonna hit. I don't want to hit, but I'm gonna hit. It's things like that. And I love the way you practice charts because you're like, it's telling me this, and there's really no variation about it. But I know you do pay attention to other things. I know you pay attention to correlations. I know you understand, what the macro backdrop is telling you. Is there anything out there that's outside of the technical analysis world that has your attention right now that you're like, I am a little concerned about this?
Yeah, I mean, I think there are always risks, right? And I think if you listen to the Fed comments, right, the market rallied pretty good post-Fed announcement and in the press conference 2:30 to 4 p.m. yesterday. Today, you're sort of getting additional follow-through on Thursday. So I don't think that was as much that we heard dramatically bullish comments. It's just we didn't hear anything altering from that general trajectory we're looking at, which is cuts are going to start coming. It's going to happen later this year. We'll probably have a couple. We'll probably have more into next year. So now we sort of have this clearer and clearer picture about what things are going to look like. And if rates come down as they're saying, and if policy eases up for consumers, that pretty much opens up the floodgates for a lot of upside potential for growth of the economy and growth of stocks. So, but what you also heard Powell say was a number of times talking about being data dependent. And what that basically means is we're going to have monthly inflation data of a couple different indicators and other information about jobs and hiring and all that. And if any of that becomes a little too overheated, that's quickly going to signal to the Fed, okay, we need to wait a lot longer for rate cuts, or we need to adjust. And he very much left the door wide open to make changes. So I think one of the biggest risks is that we now have this narrative in all of our heads of what the Fed is now going to do. And if there's any deviation from that, particularly a little more of a hawkish sort of a tone at some point, that could quickly surprise the market to the downside. The second one, and that I would say is just one of those that's been looming over the markets for years now, are just geopolitical risk. And what we've seen are a number of geopolitical and military conflicts that have escalated, but not to the point that they've really dramatically impacted risk assets. And if you and I talked before events in the Ukraine unfolded, before events in the Middle East, and said, what happens to crude oil if there's this huge issue in the Middle East and threatens, we would both say crude oil is probably going to shoot up, right? Because and defensive things are going to start rallying, and none of that has really materialized for a number of other reasons. But I would say there's always that geopolitical risk. Things in the Middle East escalate to the point that other participants join in, and all of a sudden we start to see that there are ripple effects that we haven't felt yet. Those are two. The third would be earnings, right? And earnings overall have been pretty constructive. Just today we've got things like Nike and Lululemon. I mean, names like that start to disappoint, and I think you would see downside pressure on stocks. But again, none of those three have been a warning sign. That's why the market continues to go up, is because all three of those I think have been fairly benign to this point.
Yeah, and you're right. It's very supportive, and it's hard to see anything that's going to really stop the market. Now, Dave, I love seeing your charts, and we don't have to see them today unless you want to show any of them. But I do want to ask you this before I let you go. In the markets right now, where is, in your opinion, the best trade setup on what you're looking at, and where should traders be focusing their attention?
Yeah, I would say that there's sort of three buckets of names, particularly in the equity space. If you're thinking about it, there's sort of the growth leadership, the FAANG stocks, the Magnificent Seven. And I would say if you look at many of those, they're sort of overextended or certainly well down the road of their uptrends, right? They've had really good runs. Think of like a Microsoft or a Meta. You could make the argument that owning something like that as a core holding is a decent bet, but is it an actionable idea today? I'm not sure, because it's already had such a run. A lot of those names are pretty overbought. You have another group of the defensive sectors like utilities and consumer staples. And while you see random names that are working like NRG or something in the utility sector, overall it's pretty, not a particularly strong sector. And that leaves sort of those value-oriented places, sort of industrials, raw materials. I mean, things like Dow Chemicals making a new 3-month high this week. In the industrial sector, I mentioned like trucking names, railroads, heavy machinery. I'm looking at stocks that we've sort of been ignoring for so long because the growth stuff has been so dominant in our thinking, and I think rightly so. I think this next phase in a bull market is more of a change in leadership. It's more of a rotational environment, and growth stocks might still work, but I think the other names that are just emerging are the ones I would want to be at. Home builders, I think I mentioned earlier, ITB is an ETF. That's a good way to track that space, just breaking out here recently. And I think what's good about a play like that in particular is it combines what we talk about with the Fed. If there is this sort of trajectory of lowering rates, homes have not been getting less expensive. They've been getting a little tougher to acquire because mortgage rates have gone so up, gone so much higher. If that changes, you see the Fed lowering rates, see mortgage rates come down, all of a sudden houses are a lot more affordable. I think you'll see a lot more movement, and home builders are already starting to price in that upside potential for the next 12, 18 months. And I think the charts are just starting to emerge. So I would be looking at stocks and ETFs just starting to break out. And the good news is they're out there. It's just not in the growthy names you're probably thinking about offhand.
Well, Dave, I know a lot of people are going to be listening to this interview and they're like, wait a second. I didn't get to see any of Dave Keller's charts. But that's okay, because you can find Dave so many different places that you could see his charts. And I love actually just having this conversation with you. Although the next time I do have you back, I'm going to be, hey, show me some of those charts that you look at, because I think you got one of the best eyes out there from a technical analysis point of view. So Dave, what is the best way for traders to follow your work?
No, I appreciate it, Blake. It's good to see you. Good to chat again. I hope we can do it more regularly. So for stockcharts.com is where we do all of our charting. Great. Really, if you're a short-term trader, I think connecting to the medium term and the long term, thinking in multiple timeframes is so important, and that's what we try to focus on. And obviously, we're focusing on stocks and ETFs primarily. So I encourage people to check out my show there called The Final Bar, where we recap the day using charts and technical analysis. And then my own site's called marketmisbehavior.com. And I just try to encourage people to get out of their own way as they're making decisions with their portfolios. So if that's something you want to do, check me out there as well.
All right, Dave. Well, I'll tell you, it's always great to catch up, and it's been way too long. And I do want to say once again, if I I can't remember if I said this earlier. Congratulations. I know you're a contributor over at CNBC. Congratulations on that accomplishment. And also for hitting 100,000 subscribers on your Stock Charts YouTube channel. That's awesome. So you are one of my favorite technicians to follow. Guys, gals, if you have any comments, make sure you jump down in the comments below. Give Dave a big thumbs up for joining us today. And Dave, I really appreciate your time.
Thanks, Blake. Good to see you. Take care.
Good to see you. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.